All right, so if you're looking for a shortcut to really understand the financial health of any public company, but without having to, enroll in a whole accounting course, you are in the right place.
Definitely.
We are doing a deep dive into financial statements today, and not just as, dense compliance reports.
Right.
We're looking at the balance sheet, the income statement, and the statement of cash flows as a single standardized tool, a communication tool designed to, well, reduce uncertainty for the entire market.
That's the key.
Our mission here is to unpack what accountants call decision usefulness. So that means we're going to map out the entire ecosystem of users, all 8 types.
And then contrast them.
Exactly. And then contrast how these really different groups look at the exact same data to make critical choices. Do you lend money? Do you buy the stock? Or do you maybe start an antitrust investigation?
And the statements are the starting point for all of it. This whole discussion, it connects right back to the bedrock of financial reporting. The key distinction is that we are focused squarely on financial accounting.
Meaning for the public.
For external public consumption. We're not talking about managerial accounting. That's the confidential stuff management uses internally.
Got it.
And just think about the core purpose of those 3 reports. The balance sheet gives you a company's financial status.
A snapshot.
A snapshot at a specific moment in time. The income statement, that reports its performance over a period. And the statement of cash flows, which a lot of people see as the purest report, it just details its liquidity.
Cash in, cash out.
That's it. And it doesn't matter who you are, a huge bondholder or just a curious retail investor. You are taking this historical data to make a vital, future-oriented economic decision.
And that's exactly why standardization matters so much, right? That future decision-making part.
Absolutely.
I mean, if you run a massive multinational company, you can't possibly field thousands of custom requests from every bank and every union asking for information tailored just for them.
The whole system would just grind to a halt. It's that very constraint of standardization that creates efficiency and, maybe more importantly, comparability.
Because everyone's playing by the same rules.
Everyone follows the same GAAP or IFRS rules, so everyone gets a baseline of verified information. This isn't just a regulatory thing. It's the lubricant that lets capital markets function.
Okay, so let's map out this ecosystem. We said there are 8 primary users who are all relying on this same data.
Right. And we'll focus hard on the 2 main external groups, investors and creditors, but it's useful to see the whole scope.
So who's first?
The first, and I'd argue the most analytical group, are lenders, so banks and bondholders. Their primary question is entirely defensive.
Will I get my money back?
That's it. Can the company repay the loan principal with interest? So they're intensely focused on the statement of cash flows for repayment ability and the balance sheet for collateral.
And right away, contrasting them, you have investors, the owners.
A completely different mindset.
They couldn't care less about collateral, not unless the company's failing. They want upside. Their question is, will this generate a return for me?
Dividends, capital growth.
Exactly. So they're leaning heavily on the income statement for profitability trends and the statement of cash flows to make sure that profit is, real cash.
Then you've got management. They use these same external reports to benchmark against their competition, to set big picture goals.
Like hitting a certain return on equity to get their bonuses.
Precisely. They use all 3 statements as a high-level scorecard before they dive into their own internal secret reports.
Okay, then you have the groups in the middle, the business relationships, suppliers and customers.
And their stake is all about long-term stability.
Yeah.
A supplier needs to know you can pay your invoice in 6 months.
And a customer needs to know their warranty will actually be honored 5 years from now.
So they're looking at the balance sheet and the statement of cash flows for that long-term viability. Is the company stable?
Then the next group uses these in a pretty adversarial way.
Oh, yes. Employees and unions. The income statement is a direct tool for negotiation for them. Their question is simple.
Is the company profitable enough to afford our raises?
Or to fund our pensions. That profitability data is often the absolute cornerstone of collective bargaining.
And here's where it gets really interesting, I think. Competitors.
This is basically public data espionage.
They're not asking, can this company repay a loan? They're asking, where are they weak? Where are they making their money? What are their profitable segments?
Exactly. They use all 3 statements to try and reverse engineer strategy, benchmark their own efficiency, and figure out market share.
Then you have government and regulators.
The oversight function. They're using the reports to enforce compliance, protect investors, ensure the market is fair.
And for utilities, for example, they'd use them to set approved rates.
Right. Their question is purely legal and structural. Is the company following the law, and is it becoming too dominant?
And finally, the widest lens of all, the press and the public.
The storytellers. They're looking for triggers. A sudden drop in income, a huge write-off on the balance sheet. That becomes the start of an investigation or the context for a big news story.
That whole ecosystem just shows the sheer pressure on these reports to serve so many needs.
It really does.
But that tension, that contrast between the universal data and the very specific need, forces us to dive deeper into the two with the most, let's say, philosophical distance.
The creditor and the owner.
The lender versus the investor.
And that divergence is just crucial to understand. Lenders or creditors are essentially selling money. So they prioritize downside protection.
They have a fixed return, right, the interest rate.
Exactly. Their return is capped. They gain nothing if the company becomes a massive success, but they lose everything if it fails.
And investors, the owners, they're buying risk, so they want that upside potential. Their return could be unlimited, but their capital is 100% at risk.
This fundamental difference means they can literally read the exact same line item on a report and come to opposite conclusions about whether it's good or bad.
Let's get specific then. How do their analytical lenses differ for each statement?
Okay, so let's start with the balance sheet. The lender's focus is on collateral and leverage. They want to know, what specific tangible assets can we seize if the company defaults?
Property, plant, and equipment, the hard stuff.
The hard stuff. And they're calculating the debt-to-equity ratio to see if the company is already drowning in debt.
But for an investor, the balance sheet is all about the capital structure. Their question is, how efficiently is this company using debt to boost my return?
A totally different question.
They're looking at the composition of financing. Are they using cheap debt to magnify profits? They're looking at metrics like return on equity, which is directly impacted by how much debt the company uses.
So more debt can be a good thing for them.
Right. But I have to push back a bit on the collateral point. For a huge service company, say a software firm or franchise operator like McDonald's, where the real value is the brand, which is intangible, how much is the real estate collateral really worth to a lender if the whole business model collapses?
That's a great challenge. And you're absolutely right that in today's economy, the ability to generate cash often overshadows collateral. But the lender still demands that safety net.
Just in case.
Just in case.
Yeah.
And that's why they view the income statement so defensively. The lender asks, is the profit stable and large enough to ensure the interest coverage ratio is, say, 5 times or higher?
They just need to know the interest payment will be covered with a big cushion.
Period. That's all.
Yeah.
The investor, on the other hand, sees the income statement as the engine of wealth. They're looking past simple earnings to the profit margins, the efficiency, and the growth.
They want to know not just if it's profitable, but how profitable and is it getting better?
Exactly. This whole contrast really comes together in the statement of cash flows. The lender is hyper-focused on one line, cash from operations.
Money from the core business.
Money from the core business,
Yeah.
before any fancy financing or investing. Their key question, does that cash cover the debt payment? They want maximum reliability.
But the investor is looking at free cash flow.
Which is the cash left over after all the necessary capital expenditures.
So that's the pool of money that can be used for growth or returned directly to them as dividends or buybacks.
That's the key. Their focus is not just on servicing debt, but on maximizing the return of that cash to the owners.
This contrast, it really comes to life when you apply it to a real company. So let's do that. Let's look at the 2024 data for McDonald's and see how these two groups read the same numbers.
Okay, perfect example. So when a major institution, maybe a pension fund, decides to buy McDonald's debt, so they're acting as a lender, their focus is strictly on safety and repayment.
Nothing else.
Nothing else. And they see a couple of things that stand out. First, on the balance sheet, yes, McDonald's has high total debt, around $51.5 billion.
That is a massive number.
It's a huge number. But the lender is immediately reassured by two things. First, massive stable assets of over $55 billion, a lot of which is prime real estate. Great collateral.
Okay, the safety net.
And more importantly, they look at that debt relative to earnings, which brings them to the income statement.
And for them, the income statement is a quick check mark.
It is. It shows a strong, consistent net income of $8.2 billion. That is far more than enough to cover their annual interest payments. That's the main hurdle, and they clear it easily.
But what's the most critical number for them?
It's that $9.45 billion in operating cash flow on the statement of cash flows. That number is practically guaranteed every year. It proves the business model is just a cash machine.
And for the bank, that's the money they'll get paid back with.
That is the primary, reliable source of principal repayment. It makes the loan incredibly safe, despite the huge dollar amount of debt.
Okay. Now let's switch hats completely. Put on the investor's lens. If you're buying McDonald's stock, you want profit, you want growth, and you want to know how the company is rewarding you.
A completely different analysis.
We start with the income statement, but we're focusing on margins. McDonald's consistently posts a net profit margin around 33%. For an investor, that's not just profit.
No, it's validation.
It's a validation of their incredibly efficient capital-light franchise model. They're analyzing the trend. Is this efficiency getting even better?
And that huge cash flow theater, that's where the investor finds their gold.
Exactly. On the statement of cash flows, the investor sees that $9.45 billion in operating cash flow isn't just servicing debt, it's funding aggressive shareholder returns.
Billions of dollars.
We're talking $4.87 billion in dividends plus another $2.82 billion in buybacks in 2024 alone. For the investor, this return of capital is the investment thesis. It's proof the company is mature and prioritizing its owners.
Which brings us to a fascinating point on the balance sheet, the negative equity.
Yes, negative equity of negative $3.8 billion. Now, we should explain what that means.
Right. It usually happens when a company's share buybacks or dividend payments over time exceed its retained earnings. Doesn't mean they're broke. It means they're aggressively returning capital to shareholders instead of keeping it in the company.
And while a novice might see that negative number and, run for the hills,
An informed investor sees it very differently.
they see it as a deliberate strategy. It's a sign of a company that is so confident in its predictable, massive cash flow that it can aggressively prioritize shareholders. It concentrates ownership and boosts per-share metrics, which they love.
That contrast just perfectly summarizes the core insight of this whole deep dive. The financial statements, the balance sheet, income statement, cash flows, they're universal documents.
But the lens you apply is totally specific.
It's tailored to the user's objective. We saw that creditors are driven by downside protection. They want safety, guaranteed return of principal and interest.
While the owners, the investors, are driven by upside potential. They're focused on growth, margins, and aggressive capital return.
And the financial accounting system works because it provides the reliable, comparable information that lets both of these opposing forces reduce their uncertainty and make their decisions.
It really changes how you read financial news, doesn't it? When a company announces a huge share buyback, you have to stop and ask, okay, what does that do to their leverage, and what is the bank thinking about that?
Exactly.
So let's leave you with one final thought to mull over, building specifically on that McDonald's negative equity example.
Okay.
We saw that $9.45 billion in operating cash flow. The lender sees that as the reliable source of their loan repayment, the key to their safety. The investor sees that same $9.45 billion as the source of their next dividend payment and stock buyback.
The same cash, two different purposes.
So here's the question. When a company aggressively uses buybacks and dividends, a practice that can create negative equity, does that practice inherently raise or lower the perceived risk for a long-term creditor? Is the aggressive confidence implied by the buybacks more reassuring than the increased leverage is worrying? That's the tension you, as an informed user, now get to analyze.